Hi everyone, welcome back to my channel. So today's topic is about accounting for home businesses. So why did I decide to do this topic? It's because during the COVID pandemic, a lot of people lost their jobs and a lot of people started their side hustles like working from home, starting their home business, that kind of thing. So I think this piece of information will be very important to people who have already started their business and then have no idea how to start doing taxes or do simple accounting. So this slides hopefully will help you guys. Okay, so let's go. Yeah, so business accounting 101. So it's for like sole proprietors, simple home businesses, or like property landlords to help you manage your accounts and taxes lah. So basically this like simple introduction to financial accounting, but it's much more simplified so that it's easier for a layman to understand. Okay, so normally for home businesses, what do we need? We need a statement of financial position, which is equivalent to the balance sheet. Okay, so balance sheet, what will it consist of? It will have the asset, the liability, the equity lah. Yeah. Okay, then next important financial information is the statement of comprehensive income. So profit and loss statement, income, expense, all recorded there. Okay, so the reporting period should follow your calendar year, which is ended 31st December. And then you will report this income in your Form B1. Okay, so later I will share more about the taxes portion. So now we will focus more on the accounting portion first. Okay, there are also other kinds of financial information that if you are doing full reporting, right, it's much more financial information, but they are not of like material importance for people doing just simple home businesses, so we will skip them. Okay, so according to the IRAS website, if you're a small entity, you can prepare based on this SFRS for small entities lah. So small entities is annual revenue less than 10 million, gross assets less than 10 million, employees less than 50. But this one is actually for businesses, meaning it's actually corporates. So I think if corporates can apply it, then you guys as supervisors should be able to apply this SFRS. Okay, so these are the what defines it as publicly accountable lah. But basically, if you're a sole proprietor, you won't be publicly accountable anyway. Yeah. Okay, so what's the use of this financial information? So can be managerial or financial. So it's a managerial. It will not be taught in this slides because that one is under managerial accounting. So usually things like all these are managerial. So financial, why is it financial? Why is it useful? It's for financial and tax law, for reporting purposes and to adhere to government regulation, and is actually verifiable through like source documents. Okay, so accounting is a thing that is based on accrual. It's not based on cash. So whatever cash you see is not the whole thing about accounting. Okay, that's why people who are accountants might not be good at math lah. So math and accounting is actually a different thing lah. Okay, and then we must assume this going concern assumption, meaning the entity will continue to exist indefinitely when you are doing this accounting. Okay, so transactions are recognized when they occur, not using cash accounting lah. Yeah. Okay, so some accounting terms definition for your information. Assets, what's the definition of assets? Is an economic resource that can produce future benefits. Liabilities is a present obligations that will result in an outflow of economic benefits in the future. Equity is a shareholder's residual claim to the entity's assets. Okay, so basically assets equal liability plus equity. Okay, and then income, I believe everyone know increase in economic benefit. Then expense is a decrease in economic benefit. Okay. So just now the accounting equations you need to know. So for equations, always it's double entry in accounting is to make sure that there are no errors, and then no errors, like it's easier to detect the errors. Okay, and just now this is the accounting equation that I shared. Assets equal liabilities plus equity. Okay, then total revenue and gains minus total expenses and losses will be the net income lah. So basically the other financial statement that I'm talking about. Okay, then net income or loss is usually for a period, usually a year lah, and is found in the equity portion of the balance sheet under retained earnings or loss. Okay, so this is a sample of an income statement. So basically you record all your sales and your expenses here, and then you will get your net income before tax. Okay, so before tax, then you will need to do some tax adjustments before you report it to the IRS. Okay, so in this example is about almost a full income statement because it shows income tax and it also shows dividends declared to shareholders. So as a sole proprietor, there's no need to declare dividends, so you don't need to care about all this. Okay, so classification of income and expenses can be by nature or by function. So this example is something more like by function lah. So as a cost of sales, marketing cost, distribution cost, administrative cost, or other kind of functional groupings that you can choose lah. So based on what you want to categorize all the expenses, but based on experience, I would think you classify them into like tax deductible or non-tax deductible categories will be better. So it's easier when you do the tax portion. Yeah. Okay, so back to the balance sheet. So balance sheet is about assets versus liabilities. So assets examples are cash and bank balances, receivables, inventory, prepaid expenses, PPE, property, plant, equipment. Okay, and then in some more complicated home businesses, it might have some intangibles such as trademark, patent, or goodwill lah. Yeah. Okay, liabilities, some examples are mostly payable, so like loans, salaries that you need to pay. I mean, as sole proprietorship, usually you don't need to pay salary, but yeah, okay, that or taxes lah. These are liabilities examples. Okay. Lastly, we come to the last portion, which is equity, also known as shareholders' equity. So usually when you incorporate a business, you need to come up with some amount of capital. So as a sole proprietor, usually even if you do a home-based business, right, you also need some amount of capital lah. Yeah, so this is called the equity, paid up capital to issue shares. I mean, you can do this kind of accounting on your own lah. Yeah, then any earnings throughout the years is called retained earnings. Okay, so cumulative from all previous profit and loss statements, includes revenue, expenses, and dividends. Okay, so this is an example of a balance sheet. This is a sample lah. So assets on one side and liabilities and shareholders' equity on the other side. So both must equal to each other. Okay, so let me give you an example. When you are putting in cash into the business, right, you will increase the cash assets. So maybe you start from zero, right? You increase your cash assets, and then you will increase the common stock. Common stock is actually the shareholder equity. So you can see it both balance out. This has been increased. Maybe you put in 50k, you have 50k here. So no liabilities at the moment. Only got 50k assets and 50k stock. So let's say your business doesn't need to do any debt, then technically your whole balance sheet is just assets and equity lah. Yeah. Okay. So accounting is actually a process of identifying, recording, summarizing, and reporting this economic information for decision makers. So in your sense, your decision maker is yourself, and then also for tax authorities to know what you are reporting lah. Okay, so how it works is a transaction, monetary transaction must occur, and then source documents are prepared, such as like source transaction can be like typically exchange of goods and services, but also includes events that can have economic impact on the business. So it must be actually a measurable, then you can input as accounting lah. Okay, and represented by monetary value. So example, you pay someone for some services. Okay, so like let's say you're an outsourcing company, you pay someone to do the work for you, then after that you collect revenue from the client itself, so you earn the spread lah. So that's your income statement about lor. Yeah. Okay, source documents prepared. Some example of source documents it can be actually physically or electronically captured. So some examples are invoices, purchase order, remittance advice, or receipts, payslip, all these lah. Yeah. Okay, so transaction analyze. Then you need to write a journal entry. So what you need to think about what accounts will be impacted from this transaction. Okay. Then after that, you think about it, you journalize it down, it's posted and forms a part of the financial statement. Okay, so you post the journal entry, and then based on chronological order, must always have a debit and credit lah for each journal entry, and then the monetary amount must equal to each other. Okay, so like just now the example I gave for the equity, you put in 50k for your business, both sides must equal each other. Okay. So resembling the balance sheet, we have this simple thing to keep track of all the journal entries, which is called the T account. So each asset or liability, all this, right, will have a T account lah. So like cash, you have a T account, and then usually like left side is called debit, and then right side is called credit. Okay, so if there is an increase in assets, it's called debit, and then if there is a decrease in assets, it's called credit. So let's say you take out money from your equity, so you will I mean just now 50k, right, we talked about 50k invested into the business, right? So it's actually debit assets and credit shareholders equity. So increase in shareholders equity is counted as credit. Okay, so debit, this just check it out lah. So for liabilities, when it's decrease, right, it's called debit, and then when increase in liability is called credit. Okay, so basically follow all the rules here, and you will easily get this debit and credit thing lah. Yeah. Okay, so more rules of debit and credit. So as I mentioned, actually the statement of profit and loss is also part of the equity. So share capital, just now we already shared about this. So if it's a retained earnings, credit of retained earnings, right, it's actually an increase of retained earnings. Okay, but if there is a debit of retained earnings, it's a decrease of retained earnings. Yeah, so you just follow this sign. So debit dividends is actually increase in dividends, and then credit dividends is actually decrease in dividends. Okay, same for revenue. So revenue, when you credit revenue, it means that you earn some revenue. Then when you have credit expenses, it means that you have less expenses. Okay, so when you incur expenses, is a debit of expenses. Okay, so this is basically the rules of debit and credit. When you look at this table, you understand and realize quite intuitive. Okay, so let me give some examples of journal entries. So one journal entry is just now the example I gave. So give cash and then you start your business. So cash to start your business, maybe assume 25k. So debit cash, credit share capital. So both amount must be the same. So it's equal one. Okay, so let's say you start investing on 1st July. Okay. Next example, you go and use the money to buy some supplies. Okay, so next day you go and buy some supplies. You buy some supplies is increase in asset, right? So increase in asset is debit. So debit supplies, and then credit. But then imagine you didn't use your money to buy lah. But if you use your money to buy, this one will be credit cash. But this one is you purchase some supplies on credit, meaning some store allow you to have a loan with them, short-term loan with them lah. So this, say maybe you can pay 30 days from the date of the sale that you buy these supplies from them. Okay, so actually you can start this liabilities account already called accounts payable. So increase in liabilities is credit, so credit accounts payable 10k. The amount must be the same. Okay. Next example, this one is imagine you also rent an office, then you need to pay rent lah. So at maybe you're paying rent for the previous month because it's the 1st of August, your rent is now due. So you will debit rent expense. Expense, like I mentioned, if it's an increase in expense, is a debit. So debit rent expense, and then credit cash, means your cash decrease lah. Okay. Yeah, so this is the third example. Then 4th example is you actually go and perform some services to a client. Okay, so when you perform services to a client, your client won't pay you immediately, right? So but then you need to record that the services has been rendered to this client. Okay, so let's say the services you will going to bill them 12k lah. So you have receivables of 12k, which is an asset. So one day you are going to collect it and this will become cash lah, but not the actual day that you actually perform these services. Okay, so when you earn revenue, is called credit revenue ma. Yeah, so increase in revenue is credit revenue. So these two will equal out same amount. Okay. And then with all these trial T balances, right, you will incorporate all of these balances from the left, right? So like I mentioned, in the T account, you have a left and right? So the left and right, will all combine and you have a net amount of whether it's a debit or credit. So all this, right, will go into this thing called the trial balance. Okay, so with the trial balance, right, there's a grouping of prepared all this in the following order lah. Whether it's assets first, you start with assets, then you go use liability accounts, equity accounts, revenue accounts, and then expense accounts. Okay, so maybe I'll show an example of a trial balance. So based on just now the 4 journal entries that we detailed just now, right, we can prepare a trial balance already. Okay, so the trial balance is there's a cash of 21k because put in 25k and then paid the 4,000 rental, right? So remaining the cash is 21k. And then you can see here share capital is also here just now, 25k, the first journal entry. Then we also have the accounts receivable for the services performed. So this one is actually, this one should write debit on top and credit on top lah. So basically just imagine debit, credit. Okay, so all these are debit amounts and these are credit amounts, and they both will equal each other. Okay, so these are basically all the journal entries we went through just now. It's just that we compile it into this thing called the trial balance. Okay, so what's the point of this trial balance is to identify any accounting errors lah. However, so accounting is definitely an accounting error if your trial balance don't balance lah. Okay, but some errors cannot be detected from a trial balance, such as unrecorded transactions or wrong amount recorded in the journal entry, or transaction was posted to the wrong account. So like let's say I debit, instead of debiting account receivable, I go and debit cash, right? Then nobody will know that I actually debit the wrong account because this is cannot be detected lah from the use of a trial balance. Yeah. Okay, so at the end of the period, usually need to do some adjusting entries. Like I mentioned, prepare at the end of accounting period. So this is recorded to bring an asset or liability account balance to its proper amount, to recognize all revenues earned or all expenses occurred. So there are 3 categories of adjustments, either deferrals, tax deferral, deferrals, accruals, or depreciation. Okay, so let's say you have certain assets, right? Then definitely they will depreciate during the year, so you need to record their depreciation as well. Okay, so let me share with you the first adjusting entry for deferral. Sorry. Yeah, so deferrals occur when cash has been collected or paid in advance of earning revenue or incurring expenses. Okay, this sounds very cheap, right? But we just go like just prepaid expenses. So let's say one day you pay in advance for your phone bill. That's a prepaid expense. So this one actually we count it as a asset lah. Yeah, because you have it in cash one, right? It's just that you pay it in advance, then now you don't have it in cash, you have it as a prepaid expense, so it's actually a asset. Okay, then another way is this pre-collected revenue. So let's say your customer pay you in advance, then technically it's a liability because you actually still owe them some services before you can actually collect this money. But if they pay you first, so cash received before revenue is earned, right, then you need to record a liability. Okay, then accruals can occur when revenue or expenses have been fully earned or incurred before cash is collected or paid lah. So like just now the example I mentioned, you accrue the revenue first because even though you already rendered the services, right, but you have not received it yet in cash, so it's a asset, so it's a receivable. Just not a receivable, is called accrued revenue. It's an example of accrued revenue. Then accrued expenses is expenses that you have incurred but did not fully pay in cash. So let's say you owe your workers salary, so salary payable is accrued expenses. Yeah. Okay, so deferrals, adjusting for prepaid expenses or pre-collected revenues. So like I mentioned, so if the prepaid expense was initially recorded as an expense wrongly, right, you need to go and convert the unconsumed portion to an asset. However, if the prepaid expense was already recorded correctly as an asset, you can convert the consumed portion into an asset, from the asset to expense. So let's say at the start of the month, I debit a prepaid expense of 10k, but at the end of the month, I need to pay this rental, right? So I will debit rent expense and credit prepaid expense. Okay, so that's the entry you will do at the end of the month. So same for revenue lah, just vice versa, just reverse the entry. Okay, so same for accrued expense and accrued revenues. I think I went through enough examples for them, but never mind, we can go through again. So you record the expense before you actually pay in cash, so something like salaries, interest, or like income taxes. So cost has been always incurred. Like usually at the end of the year we are supposed to pay our taxes, but then we don't really pay them exactly at the end of the year. We usually pay them in like March or April, right? So by right, we should have recorded these taxes in our previous year lah. Yeah, so this is called accrued expenses, example. And then record revenue before collecting cash. So something like yeah, you always render services to your clients, then maybe collect the money later. So these are examples of accrued revenue. Okay. Okay, example of depreciation. So depreciation is just an estimation lah, because like based on when you buy an asset, how long can it last, and then how long should it depreciate over. So let's say you allocate this to your cost of property to expense over the useful lives instead of expensing it all at one go. Because like you buy a computer, maybe it costs 20k, I don't know, just an example lah, 20k, you cannot record this expense as 20k over 1 year, right? Because this computer maybe is supposed to last you 10 years. Yeah, so you're supposed to allocate the cost correctly. Okay, so it represents wear and tear and obsolescence. So some examples: building equipment, furniture, all these lah. Okay, so how you do this depreciation is usually a straight line depreciation. You will use the set cost, so like 20k over the useful life, so maybe like 10 years. Okay, so in this example, we do it as computers for 36k, they remain useful for 3 years. So at the end of 3 years, the value of computers is expected to be 0. So when you first buy the computer, you will debit as an asset, because the asset debit computer, credit cash. Okay, so you paid cash for these computers, so this is the entry. And then at the end of the month, you need to do your monthly depreciation. So monthly depreciation is how much? It's 36 divided by 3 years divided by 12 months. So the monthly depreciation is $1,000. Okay, so you need to debit depreciation expense. So expense you always debit to increase the expense. Okay, then you credit this thing called a contra account. Contra account means there's a computer equipment asset account, and then you contra these accounts. Okay, so it's called credit accumulated depreciation of the computer equipment. Okay, so this is basically a journal entry for like depreciation lah. Okay, so at the end of it, right, like I mentioned just now, I teach you how to prepare a trial balance. Then you prepare these adjustments to balance it, to make sure everything is in order, and then you will get this thing called the adjusted trial balance. Okay, so in this adjusted trial balance, right, you will need to close all the expense and revenue accounts. Okay, this is to make sure you can close it into the balance sheet lah. So this is an example of closing all the accounts. So debit revenue, so all the revenue effort is credited, right? Now you will debit the revenue to make it become retained earnings. So you will debit revenue and credit retained earnings to close revenue accounts. And then for expense accounts, you will debit retained earnings and credit all the expense, all the different expense to close the account. Okay, so you can get your net amount already. Okay, so now I'll teach you guys how to prepare a simple tax computation. Okay, so this is a sample of an income tax computation. So from the accounts, you will get this net profit before tax, right? So with the net profit before tax, like I mentioned in your trial balance, you should have different accounts specifying what are the disallowable expenses and put them all into different trial balance accounts lah. So for this, you can easily add them back now here, and then if there is any specific deductions that are provided for under the Income Tax Act, you will go and less them off. Okay, any other enhanced or further deductions. So some deductions, they allow double deduction. So something like trade fair deduction, all these, they allow double deduction. You can do double deduction here. And then if you do any renovation, renovation is not allowable expenses, but they specifically allow it under this section, but it's not the full amount. So let's say you incur 120k this year, right? So you can claim this 120k over 3 years. So divided by 3, it should be 40k per year. So for this year, you can claim 40k lah, but you already add back 120k here. Okay, so that's how it works. Then you arrive at this thing called the adjusted profit or loss before capital allowance. Okay, so one of the disallowable expenses is the depreciation expense lah. So you need to add it back here. And then although you add back your depreciation expense, you can claim this thing called the capital allowance. Okay, so capital allowance, later I'll elaborate more on how you can claim capital allowance. Okay, so other than capital allowance, if you actually claim the full capital allowance on the asset already and you sell this asset for cash, right, then technically there's some sales proceeds coming in. This one, you need to add this thing called the balancing charge. Okay, so let's say you already claimed the full capital allowance on a 50k asset. Then currently you sold this asset for scrap for maybe 1k. So there's a balancing charge of 1k that you need to add back to this thing. Okay, then so for capital allowance is you will start with, if you had capital allowance brought forward from the previous year, maybe you make losses in the previous year, then you didn't fully utilize your CA. Okay, you have to claim your unutilized CA first, then you claim your current year CA, then you claim any balancing allowance. Okay, so what is balancing allowance? So balancing allowance is when let's say you buy a set this year and then you haven't claimed any CA for this year. Then let's say you buy the set for 100k, then somehow you sold it at a loss of 50k. Okay, so they will allow you to claim this thing called the balancing allowance of remaining. So 100k you sold for 50k, right? So the remaining allowance that you lost on this asset is called balancing allowance. So 50k you can claim as a CA as well. They don't call it CA, they call it balancing allowance. Okay, then after that you arrive at this thing called the adjusted profit or loss after CA, and then less any unutilized losses brought forward if you made losses in the year before, and then you arrive at this chargeable income, which you can declare in your form B1. Okay, so a bit more about capital allowance. So like I mentioned, for small businesses, right, capital allowance are going to be small assets lah, not going to be more than 5k, I assume, per asset. So let's say if it's less than 5k per asset, or if it is a computer or it's automatic equipment, then you can claim it over 1 year. So your CA is a full CA claim in the same year. So let's say you buy a computer for 10k, you can claim it under 1 year. But if you buy something like maybe you buy a machine and it costs just nice 5k, you can claim it under these low value assets, and you can claim it 5k in the same year. However, if you actually buy an asset that is not computer or not a prescribed automation equipment, then you can only claim it under this thing called the 3 years one. So accelerated 3 years. So let's say you buy a 120k set, then you can claim 40k each year. So 40k this year, 40k next year, 40k the following year. Okay, so that's for capital allowance. Okay, so that's the end of simple accounting and simple tax. So if you got any questions, feel free to leave me a comment. Okay, so that's the end of the video. So that one is just a very simple accounting and very simple tax computation. So it is very suitable for very small businesses. Okay, so if you need more consultation and on other specific things, you can reach out to me directly. Yeah. Okay, so I hope you learned something new from this video, and please help to like and subscribe. Thank you everyone. Bye bye.